So, this is a quick emergency update video about something that is honestly shocking a lot of people right now, the arrival of the 50-year mortgage. Yes, 50 years. And whether you're planning to buy a house or not, I really think you should watch this video, because the math behind a 50-year mortgage completely changes the future of the housing market. And here's the craziest part: on paper, it looks like a solution. But mathematically, it may be the most dangerous idea we've ever introduced into real estate. And today, I'm going to break down exactly why. Hi, my name is Andre Jick. Hope you're doing well. Come for the finance and stay for the compound interest calculations. Let's jump into it. The hook. Why this matters: most people think longer mortgages lower the monthly payment. And that part is true. But what almost no one talks about is this: the longer the mortgage, the more fragile the entire housing market becomes. A 50-year mortgage doesn't make homes more affordable. It makes them more expensive, it makes banks richer, and it traps the average person into paying potentially 2 to 3 times the value of their home in interest. And trust me, the math will shock you. Let's talk about what's happening. The big change: why a 50-year mortgage exists now. There are 2 major forces pushing this idea. 1. Housing prices have outpaced income for over 20 years. 2. Interest rates jumped faster than at any time in U.S. history. For the average buyer, a 30-year mortgage is becoming impossible. Politicians know this, banks know this, and so now they're floating the idea of a 50-year mortgage as the solution, almost like stretching a rubber band that's already near its breaking point. But here's where the math gets interesting. The math: 30-year vs 50-year. Let me give you a simple example. Let's say you buy a $600,000 home at a 5% interest rate. Monthly payment: 30-year mortgage, $3,792.50. Year mortgage, $3,200. Wow, $600 savings. Looks great, right? Not so fast. Total interest paid: this is where your jaw hits the floor. 30-year total interest, $713,000. Year total interest, $1,318,000. That means backhand index pointing right, you pay over double the price of the home in interest. With a 50-year mortgage, backhand index pointing right, literally $600 more interest for the same house. Backhand index pointing right, your monthly payment barely drops, but your lifetime payment explodes. This is why the math matters. The secret effect: home prices will go up. Here's what people aren't ready for. Whenever a new type of mortgage is introduced that increases borrowing capacity, housing prices inflate. It happened with 30-year mortgages, adjustable rate mortgages, interest only loans, 40-year mortgages. Japan tried it. Now a 50-year mortgage means backhand index pointing right, buyers can spend more. Backhand index pointing right, sellers can charge more. Backhand index pointing right, banks collect huge interest profits. Backhand index pointing right, and home prices go into a new bubble. This is why some economists call the 50-year mortgage a trap disguised as a solution. Macro force: why now? There are deeper reasons beyond affordability. 1. Governments need housing markets to stay inflated. Housing is tied to taxes, GDP, loans, political approval. If housing collapses, everything collapses. 2. Banks need long-term interest revenue. The longer the mortgage, the more stable their cash flow. A 50-year mortgage is basically bank retirement insurance. 3. Demographics are shifting. People are living longer. Millennials can't buy. Gen Z is losing hope. This is an attempt to expand the mortgage system without lowering rates. Human psychology: why buyers will fall for this is the sneaky part. Humans make financial decisions emotionally, not mathematically. If you tell someone, this house is $600 cheaper per month, they say, I can afford that. But if you tell them you'll pay €600 more in interest, their brain goes, that's future me's problem. This is exactly how credit cards, car loans, and student loans work. And the 50-year mortgage is the final evolution of this system. The reality, this is the NEW normal. Here's my honest prediction. I believe the 50-year mortgage will be introduced. And once it is, it will become the new minimum, just like 15-year right arrow 30-year right arrow 40-year right arrow now 50-year. Soon, millennials will retire before paying off their house. Gen Z will refinance their mortgage like a phone upgrade plan. Home ownership will look more like a subscription than an asset. This is the direction we're going unless something radically changes. What I'm personally doing for me, I'm not taking a 50-year mortgage, I'm not upgrading my home, I'm not stretching my budget, I'm keeping cash ready because every time lending terms get extended, the bubble grows. And I want to be ready for when it pops. Final thoughts: if everyone knows about the 50-year mortgage, will it still play out the same way? I don't know, but the math doesn't lie, and the longer the term, the more your financial freedom shrinks. I'd love to know your thoughts. Would you ever take a 50-year mortgage? Smash the like button, subscribe if you haven't already, and I'll see you in the next video.